Global trade is slowing, dimming prospects it will keep afloat the US economy in the coming months. Joining me to discuss this further is Mark O'Sullivan, CEO at Ireland Premier Global Markets. Hello, Mark. Mark, why do you think we are seeing a slowdown in global trade?
I think one of the main reasons is since obviously we saw, the financial crisis, the central banks obviously moved in, pumping the global economy full of liquidity. And it's been fairly stop-start. So you've seen this kind of a reaction when they pump the liquidity in, that, we wait 6 to 12 months, activity drops off again, and they're forced to go again. You've seen exactly that in the US recently. The Fed have gone again with QE3. And I think really now, in the markets, you have to question, is that really working? You obviously see the reaction in the equity markets, which again are pushing on all, new highs. Commodity markets and commodity currencies are obviously benefiting from this continued liquidity by central banks. But is that really trickling down into global trade? Is that really finding the end user? Is it kickstarting the US economy? Potentially, I would argue it isn't. The Fed would say without QE, the US unemployment rate would have risen by maybe another 2 million. But even with QE, the US unemployment rate is not coming any lower. And you're going to need the US consumer at some point to come in and kickstart the global economy. And I think that's going to be the continued thing for the next 12 to 15 months, the fact that the US consumer, although showing some signs of coming back into the marketplace, it's still not really there. And I think until you see that, the global trade or kind of merry-go-round of global trade is going to suffer, So I think we're a long way out of the woods, but I think we're on the right path, and I think it's going to still be central bank-led liquidity.
And what are the long-term effects and dangers of slowing global trade for economies?
Well, I think the long-term effect is kind of linked into the first point, that, we don't get out of this slump, despite the fact that central banks pumping huge amounts of liquidity into the market. It doesn't come down to the end user. It doesn't come down to the consumer. It doesn't come down to the small corporate client or the individual businessman that's going to go out there, become the entrepreneur and start his business and try and kickstart even domestically some kind of growth. You look across to China, and again, it's been pretty much consumer-led. Now, the PBOC, they're trying to deflate the Chinese economy in a fairly measured pace, but there are still many people out there that feel, you know what, you're going to get a hard landing in China. And if you get a hard landing in China, that's going to cause a lot of problems, because you look down to someone like Australia. You've seen the RBA today, they cut the base rate again, but they're trying to get ahead of the curve. They bought massively into the Chinese expansion story. As China expands, obviously it means raw commodities. You've seen the Brazilian economy and the Australian economy really benefit from that growth. Now, you take China out, and you take no growth in Europe, no growth in the US. Where does the global economy go? It goes into one huge, prolonged slump. I don't think we're there yet, because I think if you look at levels of growth, they're still fairly steady in Asia, and maybe it's Asia that's going to lead us out. If you put to one side that the American consumer is gone for a while, Europe is completely dead and buried. Asian economies and Latin American economies are potentially where you're going to see the global growth kickstart from. But the real nightmare scenario for me would be a real hard landing in China. That would spread throughout Asia, and then we would really have some problems.
How do you think the Chinese economy will be affected by damp exports?
Well, I think we're already seeing that. I think, when you look at China, you need to look at two things. You need to look at the domestic economy, which I think, I've just kind of touched upon, which is overheating. There's certainly too much credit in the system. Property prices are fairly bubble-like, and the PBOC are trying to bring that down. But then if you just look at their export markets, obviously their key export market is Europe, and you're seeing flat to no growth in Europe. Most of Europe is still mired in a recession. You've got the ongoing problems in Europe with sovereignty and austerity. You really have to see where is that growth going to come from in Europe. It's certainly not going to come in the next 18 months. And I think, then you look to the US, you could say there's some kind of consumer kind of bubbling under. But I think with the presidential elections coming up, you're not really going to see the American consumer come back into the market until next year at the earliest. Once they know the outcome of the election, you may find they're going to go out and spend again. But again, that may be fairly short-lived, and that will probably still be backed up with some kind of division from the Fed. You can never really rule out QE4. When we got to QE2, we thought that was the end of it. We're now seeing QE3. But I think the figures recently out of China, the latest set of PMI numbers, even though that showed a slight dip it's still coming in below 50. The Chinese economy is still not expanding at the rate they would like it. And again, it does leave the door open for some kind of hard landing in China. Key number we always look at over here is Chinese steel consumption. If they're consuming steel, then they're obviously physically building infrastructure in China. That number is still very, very weak, nowhere near as strong as we would like to see it. So those kind of indicators we would look at to kind of kickstart the Chinese export story. If they're building infrastructure, there's obviously some kind of a demand. There's always going to be a demand for Chinese exports, but at the moment, obviously, nowhere near the levels we would like. So, again, you have to be realistic. The growth figures you're seeing out of China, most Western economies would love to have. The US would love to have that, but it's not the levels that we've come to know. It's not 10%. It's 6.5%, 7%, maybe even as low as 6%. I think you're going to have to realign your views in Asia with these kind of growth rates. And I think we're going to have to get used to steady growth rates out of Asia, but nowhere near the peaks we've seen in the last decade.
What strategies do you think could boost global trade figures?
Yeah, that's a good question. I think we've seen it, that there's no magic bullet. Every central bank, the major central banks of the world in the West and also, in the East have turned on the liquidity taps. They're trying to pump the market full of liquidity. Again, you could actually argue that that's all that's doing is still propping up some fairly insolvent banks, and it's not really falling down the chain to the consumer who potentially will use that credit to go out and spend and go out to boost global trade. Central banks are going to be there. They're going to be there, in their own words, for as long as it takes. So you have got that kind of backstop that will certainly support any uptick in global trade. And I think even if we see an uptick in economic figures, the central banks will still keep the liquidity there. We've had too many false storms before, whereby they've turned the tap off too quickly, and the growth has dropped away. So again, I think you have to look at new markets. We're down here in Mauritius. Africa, sub-Saharan Africa, is growing at 4.5% to 5% a year. Not bad figures. It's very, very early days. So I think, to sum it all up, I think it's going to be a long, steady path back to growth. The Chinese especially looking to replace Europe as their main market, but it's not going to happen overnight.
Thanks for joining me, Mark. Well, that's all we've got time for right now, but stay tuned to Dukascopy TV for more updates and interviews. For now, though, goodbye.